Right. Answer here. This one is you've got it half right. What we need to recognize in this instance is that there are two separate CGT considerations. As an individual, as a taxpayer, I have legal personality. Everything I do up to date of death is for my account. It goes into my tax return. On date of death, in terms of Section 9 Cap HA, I have a deemed disposal of all of my assets. So at that date, I am deemed to have disposed of it for market value. So let's, for argument's sake, take my share portfolio, had a base cost of 100,000. It's now worth, I don't know, I've seen the stock market recently. Or if we want to be really nasty, talk about cryptos in terms of valuations. Let's say it's now worth 300,000. Right. So what I would do is I'll go and say market value of assets on date of death, 300,000. Base cost 100,000, capital gain 200,000, apply my exemption, no CGT payable. Right. It then goes into my estate in terms of Section 9HA, but my estate acquires those assets at a base cost of 300,000, being my market value on date of death. So effectively, I account for a capital gain. So this was my base cost. This is my market value on date of death. That is paid for in the deceased's tax return. The assets go across into the estate at that value being the 300,000 or the market value on date of death. Any subsequent sales of the assets, the capital gains or losses are taxed in the hands of the estate. So in this context, this question is wrong. No. If an asset is sold in the estate, the capital gain goes into the estate. The difference is I have to account for a deemed gain or loss up to date of death. It goes into the estate at market value on date of death, and any gain or loss subsequent is then housed in the estate. Right. And it's Section 9HA and Section 25, which gives us that criteria. So to put it very simply, in the tax return of the individual, would take the total income earned to date of death plus the deemed earnings, plus we would take into account the deemed disposal. Right. In the tax return on the estate, it's the income earned after death. And if sold in the estate, then effectively we take the capital gain on the difference between the proceeds received in the estate minus the market value on date of death. Right. Any further questions on that? Okay. One other point, sorry, now that I'm just thinking about it, something else which comes up as a question often. 9HA does have a proviso to it, and which is transfers to a resident spouse. But please note it's a surviving resident spouse, and it's where the asset goes to the spouse. So if, for example, although we did it slightly differently, my husband had to travel today. So, if he'd met his doom in a fiery car accident today, then, his assets would have gone from his estate to me. He would have paid no CGT because the assets were going straight from him to his estate to me. If, however, his will said rather, my wife may not receive a single asset, she is only going to get cash, then this rollover provision in terms of Section 9HA wouldn't apply, because it only applies if the asset is being transferred to the resident spouse.